By the end of March 2026, the Bombay Stock Exchange had absorbed a staggering blow. Within a matter of weeks, an incredible 48 lakh crore rupees of market capitalization simply evaporated. The Sensex shed nearly 1,700 points in a single session, dragging the total valuation of listed Indian companies down to 415 lakh crore rupees. This chart tracks the specific distribution of that damage, and it reveals a harsh discrepancy. The Nifty 50, tracking India's largest corporations, reflects a manageable 9.5% drop. But look beneath that top line. The broader market is severely damaged. Over 4,200 companies have fallen by more than 20%, and over 1,000 businesses have seen their valuation slashed squarely in half. If you hold an aggressive portfolio heavily weighted in mid and small cap stocks, you are likely nursing drawdowns of 25% to 45%. For the average retail investor watching their screens, portfolio Poritara Lalhe. It is completely red. The natural human response to this level of financial pain is to hit the sell button and stop the bleeding. Market veterans utilize these periods of panic as an efficient mechanism for transferring capital from the impatient to the disciplined. Consider billionaire investor Vijay Kedia. His operating philosophy is built on the premise that surviving a market crash does not require predicting the future. It requires a tested framework and absolute discipline. As he frequently points out, Paisa banta hai patience. Wealth is created through patience. That patience was forged through extreme financial hardship. Early in his career, Kedia executed an aggressive, highly speculative margin trade on Hindustan motor shares. Within days, the trade imploded, resulting in a 70,000 rupee loss. The deficit was so severe, his mother offered her personal jewelry to help recover the debt. That single event crystallized a permanent rule for his future capital allocation. Bina research ke trading, gambling ke barabar hai. Trading without rigorous fundamental research is mathematically identical to gambling. He abandoned short-term speculation and adopted a strict, long-term analytical approach. By identifying obscure companies and holding them through massive market corrections, he grew his initial modest capital into an estimated net worth exceeding 1,400 crore rupees. This graphic breaks down the first part of the proprietary filter he uses to find those companies, the S.M.I.L.E. strategy. The S stands for small in size. The logic here is purely mathematical. It is far easier for a nimble 500 crore company to expand its operations 10x than it is for a massive 5 lakh crore giant to scale up to 50 lakh crore. The M dictates medium in experience, while I and L stand for large in aspiration. The strategy filters for leadership teams that possess seasoned industry wisdom combined with aggressive expansion plans. Kedia evaluates this as niyat or niti, intent and policy. The management must have a clear track record of integrity, paired with a strategic roadmap to dominate their sector. Finally, the E represents extra-large market potential. The company must operate within a massive, expanding total addressable market, or TAM. The industry itself must have massive macroeconomic tailwinds, capable of supporting 10x to 20x growth without saturating. By demanding these strict mathematical and qualitative conditions, the S.M.I.L.E. framework isolates highly scalable business models. This process removes emotional bias from the equation, providing the mathematical conviction required to weather severe market corrections. This chart of Atul Auto's historical performance demonstrates how the framework functions in practice. Kedia initially purchased the obscure commercial vehicle manufacturer in 2004 for just 5 rupees per share. He held the position through an agonizing, multi-year sideways grind where the stock price barely moved. His patience was eventually rewarded with a 160x return on his initial investment. After exiting that initial position, he recently executed a massive re-entry, securing a 20.9% equity stake in the company. Because management had proven their integrity during the first cycle, he trusted them to navigate Atul Auto's transition into the electric vehicle mobility sector. We can see the same strict criteria applied to his 10.95% stake in TAC InfoSec, an SME specializing in AI-driven vulnerability management and penetration testing. TAC InfoSec managed to add a record-breaking 600 new clients in the single month of January 2026 alone. As a direct result of this aggressive execution, the stock surged 61% from its 52-week lows, moving against the grain of the broader market crash. A small-cap entity operating within an expanding market, backed by verified management execution, possesses the internal momentum to move against the broader market's gravitational pull. This visualization of a swinging pendulum illustrates valuation friction, the mechanism responsible for the frustrating sideways market between 2024 and 2026. This occurs when stock prices rise high enough that the market simply stops, forcing the index to move sideways until the underlying corporate earnings catch up to those stretched price multiples. Simultaneously, the market faced an exodus of foreign institutional investors. These massive global funds pulled capital out of Indian equities as global bond yields rose. This strain in large-cap liquidity created a negative ripple effect that cascaded directly into the mid- and small-cap sectors. This macroeconomic friction spared almost no one. Kedia holds a 1% stake in Neuland Laboratories, an API manufacturer that historically compounded earnings at 28.4% annually. Yet due to a sectoral derating and intense pricing pressure across the pharmaceutical industry, the stock has corrected 25% from its recent highs. Similarly, his 2% stake in Vaibhav Global, a multinational discount jewelry retailer, is currently nursing a 38% drawdown. Record high inflation in the US and UK has crushed discretionary consumer spending. When household groceries are expensive, consumers simply stop buying television network jewelry. These 30 to 40% corrections track directly with shifting global consumer cycles and interest rate moves, rather than indicating a collapse of the business models. To hold cyclically dependent stocks, you have to normalize extreme volatility. Take Elecon Engineering, a domestic heavyweight in industrial gears. Over the last 12 months, the stock has delivered a negative return of 13.8%. But if you expand that horizon to 10 years, it has delivered a 1,198% return, dwarfing the Nifty 50. Infrastructure plays are equally brutal. Ohm Infra, a proxy for India's water security push, has crashed 38% from its recent peak. The company's operating margins plummeted to 2.8% this year, following project execution hurdles and escalating raw material costs. The pain extends to aviation. Global Vectra Helicorp is currently suffering a 42% collapse from its highs. Because the company provides helicopter transport primarily to offshore oil rigs, its revenue visibility is chained to global crude oil prices. As oil prices soften, drilling slows down, and the transport provider's stock inevitably drops. The data extracted from Kedia's holdings proves that billion-dollar portfolios do not possess a mathematical shield against losses. A 35% to 45% drawdown in a mid-cap stock is a structural feature of holding aggressive equities through an economic cycle. The defining difference between a retail trader and an institutional whale comes down to mental formatting. Retail traders often operate with a frantic, pain-avoidant T20 mindset, constantly churning their portfolios and selling the moment a stock flashes red. Market veterans operate with a test match mindset. They have the stamina to endure difficult sessions and wait quietly for the compounding math to work. Kedia treats market crashes as logistic systems, mechanisms that systematically reallocate capital from the fearful into the hands of those with the highest conviction. If you utilize the S.M.I.L.E framework to select your companies, your mandate during a bloodbath is simple. If the management integrity remains intact and the total addressable market remains massive, a severe drop in share price is merely macroeconomic noise to be ignored. We want to hear how you're navigating this environment. Drop into the comments below and tell us the name of the one stock in your personal portfolio that you are holding with absolute conviction right now, despite the broader market volatility. And if you want to keep exploring the deep analytics behind Dalal Street's top portfolios, make sure to like this video and subscribe to Market Strategists India. Block out the deafening panic of the indices. Focus ruthlessly on the underlying business fundamentals of the companies you own. Do the research and let absolute patience construct your wealth.